Okay, founders, are you ready to hear a scary story at 7 o'clock in the morning? A few years ago, I met a founder with the worst formation legal situation ever. So let's call him Richard. It's not his real name. A year or two before founding the company, Richard, not his real name, reconnected with a friend from high school who was working in the same industry. They reminisced over the late nights they would spend together dreaming about the company they would start. And when Richard, not his real name, saw an opportunity in the market, he immediately called his high school buddy. After a week or two of discussion, they founded the company as 50-50 partners and got to work. They didn't need an operating agreement. They had known each other for years. They were friends. For the first 6 months, everything was downright peachy. It was just like high school. They would stay up late and debate what features to build, what customers to chase, what to do with the billions of dollars they were just about to make. Sure, Richard, not his real name, was the one who built the product. Richard, not his real name, quit his day job to focus on the business. Richard, not his real name, worked 80 hours a week to get the product out the door. There's nothing to worry about. His partner would prove his value when he actually had something to sell. And I bet you know what happened next. As the product became ready for launch, Richard's co-founder became less and less reliable. He had just gone through a painful breakup with his girlfriend of a couple of months. Oh, the poor guy. How dare Richard, not his real name, suggest that the co-founder need to focus on working on their company? After all, they were friends. Did Richard even care about his feelings? He would need to take some time off to recover from Richard's hurtful comments. So Richard, not a real name, being a badass founder, figured out how to sell. After a few terrible sales calls, he started closing deals. His product took off. Richard worked even harder, selling by day, coding by night. At the end of the year, they had made a bit of profit that Richard split and paid them each half, thinking that a little taste of the profits would get douchebag co-founder back interested in the company. Fast forward a couple of years, Richard built a pretty good business. To his credit, douchebag co-founder tried to find a home in the company, but every time he would blow up at some employee, fire them, and then need to take some time off to recover from the mental stress of that. So Richard, not his real name, would put the pieces back together, rehire the person, keep building the company. By the end of year 3, the two friends weren't even speaking. After many threats from lawyers each year, Richard split the profits with his co-founder. Does Richard, not his real name, have a happy ending? Not really. After 5 years, he found a buyer and sold the company. The douchebag co-founder almost blocked the deal because he thought that the company may be worth more. The money from the deal was not split 50-50. The team's bonuses came out of Richard's portion of the sale. And after all was said and done, Richard's douchebag co-founder made more money from the company than Richard did. After the sale, Richard, not his real name, let it go, right? No.
Richard's co-founder did.
No, Richard, not his real name. It's like, did he let it go? Like, did he think it was like, was he okay with it? No, he wasn't. I said, sort of met him as like, I still kind of want to beat that guy up. Still want to hurt him. So, are you scared yet, founders? Because you should be. Did Richard end up murdering his douchebag co-founder? Could Richard, not his real name, done anything differently other than starting with a bulletproof operating agreement? Most importantly, how do you avoid becoming a Richard? Because you know what another name for Richard is, Anthony? It's a dick. All that and more on today's How to Founder. Good morning. My name is Chris Franks.
And I'm Anthony Franco. How to Founder is the show for founders. Chris and I believe Founders are the pioneers who drive economic prosperity, and we're trying to equip them for the journey.
So, Anthony, good morning. I am excited. Today, we are going to talk about something that's truly nerdy, truly in the weeds, truly detailed, but so freaking important. And you have brought us a guest. Who have you brought us?
So today's friend, Evan Coates, is a tax analyst at Robert and Associates. He has lots of experience in financial statement operation and tax preparation for small businesses. He also has firsthand entrepreneurial experience from running his own business. He has a master's degree in accounting and a bachelor's in economics. Evan also brings a wealth of knowledge to our discussion. His combined experience as an accountant and entrepreneur gives some unique insights in the complexities of business formation. All right, Evan, welcome to the show. Good morning.
Welcome, Evan.
Anthony, thanks for having me.
Thanks for being here, man. We appreciate it. So to get this out of the way up front, you are a CPA and a lawyer and also maybe the King of England. Is that all those things true?
Yeah, and Emperor of the Universe is on there too.
Oh, okay, gotcha.
There's a lot of letters there.
So just everybody knows, Evan specifically told Chris and I before we started, do not say he's a CPA, do not say he's a lawyer. And Chris, your fundamental opening was "Don't be a dick," and that's exactly how you started the episode.
I was just opening it up. Sorry, Evan. Hey.
Sorry, Evan.
No worries. No, I've owned my share of small business. I worked on the public accounting side. I've gotten to see both sides of the desk when it comes to business formation and all of the residual problems, like Richard's problem that happened down the road.
That's amazing.
Great to be here.
Don't be a Richard. I think is pretty common. So, I mean, let's just get right into it. So start to tell me kind of, first of all, how did you come to be an expert in this space and how did you become passionate in this?
You know, I started in public accounting 34 years ago, I think it was, and got to get a flavor for that while I was still in college. Got to work with a lot of entrepreneurs, small business people. And, you know, at the time, S corporations were all the rage, right? They'd rolled out, a decade and a half before that. The CPA that I worked for at the time, at one point, I think he had 1% of all S corps in the United States. I think that's what he told me. I'd have to hit him up, but I think he's in his 80s now, so he might not actually recall. So got to see up front, what the S corp structure did for people. And back then, an S corp was a bit more complicated than it is now, and I'll elaborate on that in a bit. So seeing these small business people, between, call it 100 and a million in revenue, dropping 50 to 250 to the bottom line, and seeing what the S corp did for them, really interesting to me. And I remember being on a plane when I was, in my 20s. I was flying for a college event to Ohio, and I'm sitting next to this guy, and I go, "So what do you do?" And I lived in Portland, Oregon, so Nike was big out there. And this guy goes, "I own a sock company." And I go, "Oh, you make socks?" And he goes, "Yep, we manufacture socks." And I look at him, and I'm 20 years old. I'm probably wearing ratty jeans and a T-shirt, and I've got long hair. And I go, "So are you an S corp?" And he looks at me like, "Why are you asking?" You're 20 years old, and you're asking me what my corporate structure is. And he's like, "Yes, we're an S corp. We became one just recently." And I'm like, "Oh, that's great." And I just remember the guy just being floored that I'm, actually digging into the detail to see if he's got his tax structure set up correctly. And fast forward a few years, started a small business, was looking at different structures, and realized there's some drawbacks to being an S corp. Expense to maintain, things like that. So the next one I did was more of a partnership. Then I went into the corporate world, forgot about that for years, exited the corporate world, bought a small business, opted against the S corp status again for various reasons, and then went back into public accounting. So kind of this long, bumpy road of seeing and experiencing the different structures.
I think it's, the picture in my head, you damn hippie accountants, always with your long hair, and ratty jeans.
Yeah. I didn't look like anybody should be asking anything about his company at that point in time.
I bet that the sock guy was pretty there.
I think he went back to talk to his accountant to see what was going on. So, the passion for small business, I think everybody listening to this and definitely you two share that, right? It's hard not to be excited about that energy. And it doesn't always interpret well onto the tax and accounting side. You know, your CPA will be like, great, be an S-corp. There's your $300 bill. Deadpan, right? Without digging into the details. And I think that's what we're going to talk about a little bit here today.
Yeah. So I have, if I can jump in here really quick. So can at a high level, I just have like two related questions. One, do I need to care about my legal entity? Like, can I just start as a solopreneur and as Anthony Franco and just send out invoices as me? And why wouldn't I want to do that? And then if I don't, or maybe there are circumstances when I do, and then what are my options? So forget about what option is best. What are my options when I want to form a legal entity around the thing that I'm doing?
Yeah, awesome question. And it's usually the first one that you know, people that are starting businesses kind of try to ask. They don't usually ask it with that level of knowledge or detail. And that's no disrespect. It's just a fact of it's complicated. So simplifying it a little bit, legal entity and tax filing entity can be and often are two different things. So your legal entity probably should be an LLC. LLCs are a state level entity. Okay. So the state of Colorado, you can go to their website, you can create an LLC. You can say, I'm Anthony. I'm going to send out invoices. Here's my Anthony LLC. For tax filing purposes, you have some options, and you actually need to choose options in most cases. You can file papers with the Colorado Secretary of State, be an LLC, start your sole proprietorship, and report it on your Schedule C. And that is easy, fast, inexpensive, and you don't have to give it much thought. And then Richard's situation kicks in, and you're 5 years down the road, and you've got something different going on. So realistically, and I've done this, right? I had a side gig I did. I started an LLC. I filed it on my Schedule C. I didn't pay an accountant. I didn't pay for payroll. I didn't pay for an attorney to set up the operating agreement because it was a sole member LLC. Super easy, super standard. Lots of people do it. It doesn't make sense at certain income levels. And that's where you need to think about, you know, a few different questions. I would say the questions really boil down to, what are you going to do? Who are you going to do it with? How much do you expect to make? And where's the exit, right? Those four things really kick in here. And I think the first question is exactly what you just asked. What are you going to do? Is this a side gig, you know, the quintessential side hustle where you're going to go and, you know, I'm going to work my 50 hours a week in the corporate world, and I'm going to do drinks out of a trailer on the weekends for events or something like that, right? You know, it's, if you're going to do it alone and you're not going to have a lot of income, a lot of profit, I should say, an LLC filing as a sole proprietor absolutely makes sense. And you don't even need the LLC. You know, I think every attorney on earth, every CPA is going to say, get an LLC. It's cheap and easy. You know, you don't even have to do that. You can just go out, start doing business as Anthony, and you can send out invoices and you can report on your Schedule C. So really the what you're going to do drives part of that question. Now, if you're a founder and you've got big dreams, you can start as an LLC that files as a sole proprietor.
I think it's one of the kind of really, it's a super interesting question, because it's one of the things that I think that we sort of believe as founders is like, oh, well, first of all, my silly little services company probably will IPO in 3 years. And so, you know, probably need to make sure that I have multiple stock classification. And the second thing is we don't believe we can change the entity. Like, talk about, is it hard to change the entity?
Chris, hold on. I would love Evan to talk about, so we've talked about sole proprietorship and be able to do that. We've talked about an LLC. What are my other options? And then,
so,
Chris, I want
to getting back to that,
I just want to wrap my head around what are the things that what are the entities that I can create?
Sure. And again, you're probably going to start an LLC at the state level as a base for all of this, right? Unless you're going to do the old style S-corp or the, you know, C corporation with articles of incorporation, meeting minutes, board of directors. An LLC at the state level, so Colorado, Wyoming, every state has the ability to form an LLC. LLCs, in the eyes of the IRS, they don't know what to do with them, right? If you say, hey, I file as an LLC, they're going to be like, well, are you a sole proprietor? Going to be. So realistically, that operating agreement LLC.
Hold on, Evan.
Yep.
Evan, sorry to interrupt, but you cut out there. Could you repeat that?
Oh, sure. Yeah. Sorry, I don't know how far back I should go, but the LLC is kind of the building block, right? The IRS doesn't have a concept of LLC. They're going to expect to see a tax return, either a Schedule C on your personal return. They're going to expect to see an S-corp return, a partnership return, or a C-corp return for that LLC. So basically, you kind of opt into how you're going to file the taxes for that entity. So LLC operating agreement probably should exist for everybody. How you elect to pay the taxes is the kind of the next step. And again, if you're a single person, you got a small business, you're going to do under 40 grand, 50 grand in profit, you're probably going to do an LLC and just file it on Schedule C. And part of this process actually revolves around when you request your employer ID number from the IRS. They're going to ask you some questions. And they're going to say, hey, is there more than one of you? And if you say no, they're going to say, great, you can file as an individual. You could always do an S-corp election. If you say there's more than one of us, the IRS is going to say, well, you're going to file taxes probably as a partnership by default. You can elect to be treated as an S-corp. If you really wanted to go the C-corp route, that's a different discussion, but you could do that. So that's the who you're going to do it with question, which is the next one, right? If it's just going to be you can be a sole prop, you can be an S-corp. You can file for an LLC and just do both of those things. If there's more than one of you is when it gets a little tricky, right? The IRS is going to expect to see both of you reporting your income for that entity. Partnership, S-corp, very common for 2 or 3 people getting together and doing a business. That's a lot of details. Stop me. Tell me
That's good. I appreciate it.
Yeah. All right, Chris. What was your question again? I'm sorry I interrupted you. I just wanted him to get through that.
Yeah, no, it's okay. I think now it's kind of a multi-layered question, which is you can change, right? Like you can change business entities along the way. Yeah. And I know that this is like we're moving sort of parallel in both tax and legal, but at what point in time does it make sense for you as let's say that I'm a sole proprietor, that I'm just out there myself, and then suddenly like I'm starting to actually do a little bit more. What does it make sense for me? Maybe let's say it's Anthony and I, we're just kind of messing around. What does it make sense for us to?
Let's not say it. Let's actually talk about how to founder and what we're like.
Right, so
let's use us as a use case here. So Chris and I we created How to Founder. We haven't formed a legal entity yet, honestly, because Evan, we were waiting to talk to you, and so now we have, I would say we have grand vision, but reasonable expectations on where we're going to go with How to Founder. So likely, I mean, could we take on investment eventually? Maybe, but not in our immediate plans. Could we bring on another partner or two? Yes. But they wouldn't have the same like voting rights under the operating agreement as Chris and I would. So how should we be thinking about both the entity that we file with the Colorado Secretary of State and how to tell the IRS? I'm guessing, I'm spitballing here, but likely not.
Okay. So, there's 2 of you. So that answers the who, right? Who are you going to be doing it with? You're going to start out with 2 people. So immediately you're going to go towards partnership or S-corp, fringe possibility of a C-corp, right? Partnership gives you some different flexibility than an S-corp. So S-corporations are limited to 100 shareholders. Partnerships, pretty much unlimited. And you can have general partners and limited partners. Now, on the tax side, that is an election, right? There's 2 of you. You've got an LLC. You file for an EIN. It's going to say, we're going to treat you like a partnership unless you file a Form 2553 to do an S-corp election. The election to be treated as an S-corp is optional, and it can be filed by pretty much any attorney, any CPA. You could probably do it yourself if you really wanted to, but you might want to have a professional handle that sort of stuff. So realistically, you're looking at if it's going to be you 2 as the main people, and you're going to have some silent partners. Partnership sounds like it's moving in the right direction. Partnerships have some flexibility around how you can allocate profits and losses. S corporations, generally speaking, you're supposed to have 1 class of stock. Now, I've heard attorneys say that you can change the voting rights or you can have different voting rights. I haven't dabbled in that, not an attorney. Harvard wouldn't take me for law school. It was horrible. So I became an accountant. So realistically, you're probably headed towards partnership. And because there's two of you and you have an LLC, you probably have to do that the first year you're doing business. So you won't be able to do what small businesses can do. I got this, a guy I worked with comes in the office and he goes, I want to start a C-corp. I'm going to have 25 LLCs under it. And I want to do this and this, and I want to be able to spin that off. And I go, what are you going to do in revenue this year? He's like, I'll probably do 50,000. And I said, well, we might want to just take a baby step, right? So if there was just one of you, and I think a lot of founders do tend to do, they're kind of driven to do things on their own. Starting as an LLC and looking at that S-corp election down the road, right? If you don't bring on a partner, look at the S-corp election down the road. When you net $40,000 to $50,000 as a sole proprietor, you should look at moving to the S-corp status, doing the election. You don't have to do it in the first year. You don't have to do it in the second year. You can do it at any point after you become an LLC, filing as a sole proprietor. And the key is you save on some of the self-employment tax. There's some other factors there. There's QBI. But realistically, you save on some of that FICA self-employment tax, right? Sole proprietor, you're paying both halves of it. It's a pretty good chunk of change. As an S-corp, some of that will be treated as distributions, and you'll put yourself on payroll. The reason most people suggest 40 to 50,000 in profit is you're going to pay someone to do that corporate tax return. Generally, what I see in the market is $800 to $1,200 a year to do an S corporation return, and you have to put yourself on payroll. So even though you own the company as an S corporation, you're going to be an employee of that company. And as an employee of that company, you're going to be subject to W-2s.
So, Evan, I went to Harvard of Central Fort Collins, called Colorado State University. And,
fantastic
you can't
institution.
you can't really say it's the Harvard of Northern Colorado because, Greeley's a pretty good school too. So
right.
It's, the Harvard of Central. So just explain it to me like I'm four. So the idea there is if I'm making a little bit of money and it's just coming right into my account, I'm still gonna have to pay taxes on that. Mm-hmm. But the moment that I kind of go up a little bit, I started payroll taxes, things like that's, I sort of get lost at that step.
So as a sole proprietor, you're already paying payroll taxes, basically.
What?
Yes.
Oh, no, shit.
Right? Shocking.
Oh, no, I'm joking, but I made that mistake my first LLC.
It happens. So yeah, self-employment tax applies to sole proprietors filing a Schedule C. S corporation just changes that structure a little bit. So I think the key component here is if you're starting an LLC and you're going to just be working by yourself, and you don't expect it to generate 40 to 50,000 in profit, you don't need to look at that S corporation election yet. With your S corporation comes some complexity, right? It's an extra tax return. You'll be filing payroll reports and cutting payroll, and you're probably going to pay a payroll service for that. Generally speaking, the cost is going to be $2,000 plus a year just to have the S corporation do your payroll and file the tax return. So counter that against the self-employment tax savings is kind of that magic equation. And just a quick note.
With an LLC, I could just take the money in. Now I'm still going to have to pay taxes to it.
Yep.
But the moment I go S-corp, I have to do payroll.
Yeah. The IRS frowns on it when you take distributions without being on payroll. There's numerous court cases about it. Definitely want to put yourself on payroll. I see a lot of S-corp owners make this mistake, right? They don't do the payroll, or they forget in the first year, or they're like, I don't have enough cash flow. From what I've read, the court cases say the IRS will come back and they'll say, hey, these distributions you took, you didn't take payroll. So we're going to make some adjustments and you're going to pay some extra money. Again, depends on the case, depends on your CPA, your attorney. But realistically, that 40, 50,000 mark is what I think most CPAs, most attorneys recommend. You look at that S-corp status. Now, partnership's completely different, right? If you start as a partnership between the two of you, you might switch to an S-corp at some point down the road. Sounds like your structure with potentially limited partners and investors might best be just treated as a partnership.
Just to put a wrapper on the S-corp. So I know that there's a benefit, there's a tax benefit, but I don't really get it. So I put myself on payroll, but then do I get to take additional money? Like what's the reason?
Yeah, I think you've actually nailed it in a nutshell there, right? So sole proprietor, you're paying both halves of the employment tax for your self-employment earnings. With an S corporation, you put yourself on payroll. So say you make $100,000 in profit, right? As a sole proprietor, you're going to pay the self-employment tax on that entire amount. I think it's 15.3%. As an S corporation, you're going to pay yourself half as payroll, and you're going to take half of that self-employment tax and apply it to that. Your distributions, I should say the profit allocated to you from the S corporation will be the other half. So say you made $100,000, you paid yourself 50 on payroll, and you basically took 50 as distributions. That other 50 isn't going to be subject to the self-employment tax. And that's
Wait, I don't have to pay taxes on that? That's brilliant.
Oh, no.
Oh, shit. Sorry.
Self-employment tax.
Self-employment.
So different animal there. So you will pay tax on it. Believe me, there's no free lunch in taxes.
Ah, dang. I thought for a second I was going to just be weird, like no taxes. Yep. It's amazing.
Yep. That is going to flow through to your personal return. That's why they're called flow through entities or pass through entities. It's going to pass through to your tax return on a K-1, and you'll pay taxes on it at your personal rate. So there's no way of getting out of it, but you do save on the self-employment tax.
And that really is the key. Generally, there is some savings there if you do.
Generally speaking, yeah. And 40, 50 grand is where that equilibrium point is, where your cost to do it with the S-corp return and paying someone to do your payroll. There's a million payroll services out there. That's where the break even generally is. And that's what I've heard recommended for years. So in your case, you're probably going to be a partnership. There's some flexibility there, but from what you described, sounds like in the short term, you should probably do a partnership. And that is a separate animal. You are going to be paying self-employment tax, but there's some flexibility advantages to what you're doing.
And then when we file it as a partnership with the IRS to get our EIN, is there any special designation we need to make sure of when we apply for that EIN?
When you apply for the EIN, it's going to ask you a series of questions. I think there's about 10 of them.
Yep.
And one of those questions is going to be, is there more than one of you? And I think I see two of you on the cast here.
It's one and a half, really.
One and a half,
I'll let you decide which one's the half, though.
Right. They're going to ask you some questions.
It's two halves. And we make one real man.
Right, exactly. It's like our first one. You saying that if we work together, we can be one full person.
You cannot file a Schedule C for two of you. I just want to be clear on that. So, okay. You're going to fill out some questions when you apply for that EIN. They're going to send you a letter that says, we think you're this. Please file. We're going to expect to see, form number, yada, yada. So it's going to be based on those questions when you walk through that EIN application. And that's the default. That's what they're going to expect to see. And you're going to want to either follow that letter's instructions for which form to file, or you're going to want to take some action with an attorney or CPA to adjust that status. So realistically, they're going to help walk you through the process, send you a letter saying we're going to expect to see a partnership return from you for this EIN number.
Okay.
So let's go ahead, Anthony. Sorry, buddy.
Well, I remember, Evan, when we first spoke, you said something about there was this special thing that you needed to do. Gosh, I wish I remembered exactly what you said, but make sure every LLC that signs up, you sign up as this entity, this type of entity, because it gives you some special advantages when I think it was taking on investors or when you exit. There was something that I remember you saying, and I can't remember for the life. And maybe I'm hallucinating it, but I remember there was something unique that you were talking about that we need to take into consideration.
We covered a lot of topics in our first conversation. I think we might have both been a little over caffeinated for that, hour and a half short 15-minute conversation we had.
I had tequila in my coffee. I didn't tell you.
Oh, that makes a lot of sense now. I get it. All right. Well,
as we both do every morning, Evan, why do you think we keep going to the coffee? It's
breakfast of champions, man.
Exactly.
I don't recall that particular wrinkle, what we were talking about. I think it was probably may have been related to multiple members. Okay. Again, that multi-member thing is important in this equation, right? Single member LLC, you have the flexibility of doing sole prop or S-corp, even a C-corp for tax filing purposes. Multi-member, you're going to be a partnership by default as soon as you get an EIN. And I've seen married couples make this mistake, right? Married couples, they go into a business together, like, well, we're just going to report on our Schedule C. If you and your spouse decide to start a business and there's two of you and your operating agreement says, I own half, my spouse owns half, you're most likely going to have to file a partnership return. You're not going to report that on your Schedule C just because you're married. And that is, that multi-member thing is a key component of this. It's the who of what you're doing. Now, we talked about the what, what you're going to do, who you're going to do it with. And then we talked about the how much, right? If you're 40, 50 grand, that S-corp election makes sense. If you are a sole proprietor or there's a couple of you, you're not a partnership. The exit is important too, right? And I'll leave a little tickler here with, what the exit looks like. I see a lot of people that want to save money on their taxes. They become an S-corp. There are other options out there that make a lot of sense. And I think this is a topic for a different time, but QSBS. And I think every founder.
What it is. That's what I remember. Yeah.
Thought you might be heading that direction.
Yeah, that's what I was talking about.
I would urge every founder who thinks they're going to grow to a large size to look at QSBS. QSBS is qualified small business stock. It is an incentive for small business entrepreneurs that want to grow to a fairly good size to avoid, I shouldn't say avoid, but to take advantage of some of the rules that allow for an exclusion of some capital gains when you exit. And it's a large number. I think it's 10 million in capital gains that's currently excluded if you hit certain criteria. QSBS, and I'll give you a couple of short points on it. You start as a C-corp. So a little bit different than the conversation we had. But if you're going to grow a company to and sell it for 50 million and you start it for $500,000, you're going to be looking at some capital gains there most likely. And QSBS is a vehicle where you can cut down on the tax impact when you do the exit. You have to get to this early in the game. You don't want to be 5 years into it and go, why didn't I do a QSBS? I've actually had this conversation with two people that were exiting their businesses. And they're like, so can you figure out the capital gains that I'm going to be paying? I'm like, yep, it's a lot. QSBS does provide some relief in that arena, really geared towards people who are going to grow to a large number and are willing to be a C-corp in the short term. At C-corps, you have what people refer to as double taxation. You've got 21% on the front end on profits, and then you've got tax on dividends. Sounds awful. It's not nearly as bad as people think. And I think we should cover that in detail at some point in the near future.
Yeah. So in Chris and I's example, so why wouldn't we start as a C-corp under this QSBS?
I don't know. Do you guys think you're going to grow that big? I mean,
we're going to.
I've gotten to know the two of you now, so I'm not sure.
Well,
yikes!
You've known us, yeah.
No, kidding completely.
I think it's the answer is, and I think for a lot of founders is that we have big aspirations, but since Anthony and I have been doing it a while, we also have realistic. We know how hard this is. So, would we love this to be $1 billion company? Sure, but is it?
But even if it's not $1 billion, so look, I think Chris and I, we're not thinking about the value of the company. But if I were to I've built 8-figure companies before, and I can see this being an 8-figure company. So maybe we have aspirations there. So I want to talk a little bit about this, about how long can we wait before we decide we want to be a C Corp and QSB? Can we file as an LLC now and then next year go, you know what, we need to, this is going to achieve what we want to and switch to a C Corp QSBS?
The QSBS, I'm going from memory here. I haven't refreshed my memory on this in a while, but I would say the initial issuance of stock is important for the C Corp. The valuation's fine. It's got to be, I think, under 50 million. But you have to start as a C Corp. And I think there's a conversation to be had there related to, should you do the articles of incorporation as opposed to the operating agreement for an LLC? Because remember, a C Corp, those were around a long time before LLCs.
Right.
LLC is a state level entity. C Corp is a state and federal level recognized entity. So realistically, I think it's a conversation to sit down and walk through it. I don't know that I'd want to give a judgment call on that right now. Something to definitely involve attorneys with. So that's another consideration.
Yeah, it's expensive.
You want attorneys, you want CPAs, you want to make sure it's ironclad if you're going to go the QSBS route. So, I think, you said you're on a shoestring budget and you guys are, milking this for every dime you have. So I wasn't sure that was in the budget for you. But realistically, it's worth a look, right? I mean, you spend the money now, but you get this nice exit after a number of years when you get bought out.
Well, I think so. I'm playing possum a little bit because what I dealt with this past year was S-corp taxation. We don't have to go into this, but having to move it to a disregarded entity for them for me to be able to exit, and then a whole shit ton of capital gains that just destroyed my taxes this past year. But I think for our process, and I think for any founder, the reality is that we don't know, right? And most founders, when they just get started, they're just kind of starting stuff and they don't know if it's going to work, and maybe it's going to work, maybe it's not. Like, what are the reasonable places in your mind for us to say, okay, we're just going to work together, we're going to have fun, and then at some point in time we actually need to make an entity, and then at some point in time we need to think about more seriously about the structure of that entity. And to Anthony's point, is there any deadlines there? It's like, hey, by the end of year 1 we need to make this decision, or the end of year 2.
Right. Your operating agreement's going to drive some of that, and your income's going to drive part of that, right? Do you have revenue? If you don't have revenue,
what is this thing you speak of called
this revenue thing? I know, right?
Revenue.
It's what everybody wants, and not everybody gets.
I'm not familiar with that term.
I think that I read somewhere once the point of small business is to actually make a profit. And then
what?
And then I worked for a CPA who said make sure they don't make any money. So I get mixed messages on this.
That's great. That's a good point.
The truth is, revenue is going to kind of drive it, right? If you're in the startup mode, you don't necessarily need to make these decisions till you have revenue, and it's going to drive some of your decision making.
If we make like $1,000 a couple months, whatever, like we could just be like, hey, we'll throw that into our individual tax returns. Not that big of a deal.
I think the IRS might have something to say about that.
Okay, so as soon as we start making revenue.
Yep. As soon as you start making money, you need to take care of this. Right.
Okay.
Because you are partners in the operating agreement. There's more than one of you. So you probably need to head down that partnership path. And I'm sure there's CPAs out there that have workarounds, right? Maybe cut somebody a 1099, yada, yada. But I think, mostly by the book, you'd want to be filing the partnership return.
Okay. And then the second part of the question, what about deadlines? Like, so, we're an LLC, maybe a year or 2 years down the road. Is that if we want to think about the C-corp? What I always heard is that C-corps are harder to do later.
You know what? You're on the money with that, I think. You can change. There's different forms to file your different elections, right? So changing from a sole prop to an S-corp, Form 2553, pretty simple, right? There's other forms, and I don't remember the numbers off the top of my head, that can be filed to change entity structures. Now, part of it's driven by your operating agreement, right? What does it say? If it's silent on the tax filing, you probably have more flexibility. There are different impacts from changing different entities, right? Converting a C-corp to an S-corp has some impact. All of these need a professional review, right? If you're going to get 2-3 years down the road and you're like, wish I would have done this, get professional help. I actually just talked to a guy. He's really successful founder. And he did what's called an F reorg. And don't ask me to explain it because I actually didn't dig into it. But he had to do this down the road. He had a change in entity. He had a change in the ownership. And he, once they started to hit critical mass, I think they got to 25 million in revenue. And they're like, ooh, this is not the structure we want. So they got an attorney, they got a CPA, they sat down and they said, look, we're going to restructure this because we think the exit is 3 years out at 100 million plus. And we want to get it right. And I'm not the guy to take you to 100 million, just to be clear. But I would say that at some point you have to review where's the exit, right? If you're 5 years in, you're like, ooh, yeah, we got a lot more revenue than we expected. Restructure it, spend the money, get the professionals. There's great tax attorneys out there. There are amazingly high-powered CPAs that specialize in this stuff. Get the expert advice, do the restructure the right way. That's really the key to this, right? And you can go into the plan, but I think, what was it, Mike Tyson said, everybody's got a plan until they get punched in the face.
One of my favorite quotes. Yeah.
Yep. So you got a plan. You got people you're working with, you're not working with. Keep your eye on what the exit looks like. The exit can be a moving target, can change, right? The gentleman I talked to started as a side hustle, and now he's hit 25 million in revenue, and now he's thinking the exit is 100 million plus. Not what he'd planned. Didn't start it with the way anybody else would have. Didn't do the QSBS thing, and is reorganizing it, restructuring it, using professionals to do so as he's moving through it.
So the fact that there's some, I mean, there's, if you're going into this thinking you want a $20, $30 million, $100 million exit, it probably makes sense to go through the upfront expense of going to a C-corp QSBS. But given what Chris and I are doing, we're not certain where this is going. So, and I'm using us as an analog for other founders, right?
Right.
So when you're in this loosey-goosey stage of trying to figure it out, one, if you don't have revenue, don't bother with it. It's fine. It's just extra added paperwork that you're going to have to worry about. And two, if you do have paperwork, if you do have revenue, start with the simplest option to start, and then kind of graduate as your business starts to mature.
That's what I commonly see, and that's personally what I would do. Right? Start with the low cost structure, because you're experimenting. Right? You don't know if that business is going to work. If you've got a sure thing, please sign me up. If you got a $100 million exit that you're going to hit, I would love to be part of that team. But the truth is, some businesses start small, get big. You can reorganize down the road. The QSBS, if you think you're going to have the next big tech thing, look at the QSBS stuff. If you are doing a podcast with your friend Chris, I would say start simple. Do exactly what you've done, operating agreement, look at the LLC, probably get your EIN, get the partnership, file a partnership return at the end of the year. Or you could, you could structure it so that one of you owns the entire company, the other one's working off of a, 1099, or you hire them on for W-2. Simplicity, I think, for the smaller companies is important. And with complexity comes expense. So I'll go back to the client that came in and said, I want to start a C-corp and I want 50 LLCs under it because I might want to spin off a business someday that I haven't started yet. I'm like, so you're going to keep track of all that? You're going to put that in your filing cabinet? Do you have an attorney? How many returns do you want us to file? And he ended up going the S-corp route with a couple of TPAs.
I think that I have one more technical question, but I think, Evan, just to put an exclamation point on that, almost everybody that's in that kind of formation phase, they spend a lot of time and energy worrying about legal structure. Mm-hmm. When the reality is that we live in a legal and tax system where it can change. And so, does it get more expensive down the road? But you're making more money at that point, and the company's worth more money at that point. So then you figure it out down the road. You don't need to have this completely nailed on day one. Just start with an LLC, and you can figure it out as it gets bigger.
That's kind of the approach I take. And again, I think my passion, my expertise is on the smaller end of the scale. So there are people that do startups that are probably going to be huge. Those people should talk to people a lot smarter than me, which is not difficult. There's two of them right here. And they should get the professional startup advice from the guy in Silicon Valley, or the lady in Silicon Valley. And I think that that's one method. But what I have seen, and I've seen people go from, I started an LLC and I did my Schedule C to next year they're an S-corp, and then they're all of a sudden they're making all kinds of money and they're coming back for tax strategies to figure out how they can reduce their tax bill. That at the smaller level, you're going to save on the upfront cost, right? Your startup cost. You're going to have simplicity, right? Once you start making things complicated, then you're going to have different conversations, and it's going to take your time. And I think, Anthony, you told me that time is the most valuable commodity in this space, and I'd have to agree with that. So taking up more time to do your payroll, taking up more time to talk to your accountant about your S-corp return, those things are going to happen. But if you're going to make 10 grand in profit from a side hustle in the next year, you don't need to be an S-corp.
One just final technical question before we start to wrap this up.
I got one too, Chris.
Okay, so we're talking about LLCs. If we're an LLC, it's just Anthony and I. Should we do payroll? Should we pay ourselves any salary? And is there any benefit to doing that?
Not until you get to that 40, 50 level, right? So in the short term, you're going to probably be a partnership, could be an S-corp, just depends on where you go with, investors and bringing other people on board. Partnerships, you're not going to pay yourself a W-2, right? You might do guaranteed payments, which is payments for providing services to the partnership. There's different aspects to that. But realistically, unless you hire an employee as a partnership, you would not do a payroll service, right? S corporation, you're going to do a payroll service no matter what.
We're 1099 folks in the partnership then.
You're K1 folks.
K1.
So, yep, K1. So you're going to get a K1 from your partnership return if you end up going that route. 1099 is for, non-employee compensation or miscellaneous compensation. That's what you would pay a subcontractor that comes out and, I don't know, builds your website or something like that potentially.
Right.
So, yeah, you're probably headed towards no W-2 because you're not going to hire. I didn't see any assistants on the call today. I don't think we have any. So I think you're probably not going to need a payroll service.
Actually, I am the assistant, Evan. That's
okay.
Yeah,
all right.
I'm the janitor. So
yeah.
Who's in charge here? Who's in charge?
I think it's you. I think that's
We're looking for volunteers.
Yeah, exactly.
Well, welcome to the podcast. My name's Evan Coates. I'll be your host today. Everybody wants a tax guy doing the hosting of a podcast.
Absolutely. Yes.
Do you think there's anybody left awake in the podcast?
I told you, Evan, before we started, there are a few people that are like glued to this conversation because they need the information. But everybody that's not thinking about being a founder, they left us at the
right
halfway through Chris's story.
No, they left us at. And here's Evan Coates.
I fell asleep at Chris's story.
I want to point out two quick things. One, nothing I've talked about is legal or tax advice. Talk to your CPA, talk to your attorney, standard disclaimer sort of stuff. One quick correction. So I worked for a fabulous CPA firm, Robert & Associates up in Evergreen. The owner is one of the greatest CPAs I've ever met in my life. She's amazing. They've got a good team, but I actually left there. So in the intro, you mentioned I was at Robert & Associates. I'm actually with Wombolt & Associates now. So a lot of associates in the world just went from R to W. I'm working my way through the alphabet.
There you go.
And
are you the King of England?
There was this little family story, and Grandpa wasn't Grandpa, so I might be.
Oh, yeah, that's good.
There's a strong chance of that, actually. And I grew up in that area, so no.
Oh, there you go. Exactly.
But yeah, so I'm with Wombolt & Associates now, fantastic RIA. We do a lot of tax planning for, folks that are exiting their businesses, things like that.
And I kind of have so we've been talking a lot about small business and starting. I just would love your opinion on something that's been topical and that. So, if you're going to get if you're going to go try to raise seed, Series A, Series B, if that's the kind of startup you're starting, it has been the common advice to start as a Delaware C-corp. And the reason has been Delaware is more founder friendly, more corporate friendly than any other state. But that has recently changed given what has happened with Tesla and Elon Musk. And Elon is now saying, I'm going to incorporate in Texas. Just wondering if you have any thoughts. And it doesn't have to be professional advice. It's just I'm curious about how you've seen that unfold and what you think about it.
And you're talking probably a league up from mine. So I'm the rec league, and then there's the semi-pro league. So that level is for decades people have talked about the Delaware incorporation, right? There were some advantages to it, inexpensive, some privacy, favorable laws, et cetera, were the things that were talked about, right? I'm not commenting on the nature of those because I never actually looked that deep into it. I think the Elon Musk case actually really proved something, though, right? I mean, it depends on where you're at, what courtroom you're in, how aggressive someone's coming after you for different things. And, for getting funding, there's formulas for that. There's CPA firms that specialize in that. There's attorneys that specialize in that, right? They'll walk you right through the process, and they have their contacts and they have their process. I've had people, I recently talked to somebody that was talking about Wyoming LLCs as being an advantage over Colorado LLCs, right? It depends on the expert you're talking to. And, I think boiling it down to basics, right? The point of an LLC is a limited liability company. And everybody says, well, you should be an LLC. Does anybody know why? Well, it's limited liability. Is it? I talked to a really bright tax attorney, 6 months ago. And he's like, yeah, depends which courtroom you end up in. I mean, the judge can just simply say, that's you doing business. And I thought it was, educational, terrifying, right? Everybody's got an LLC. They think they're safe. And then, they get in the wrong courtroom. This is all what I've heard from attorneys, horror stories. Most of the time, for smaller level, LLC at the state level makes sense, the state you're in. If you're going for something bigger, I worked with a guy that did an LLC in Colorado, and he was using safe notes as opposed to Series A, Series B funding, things like that. And just a quick disclaimer, safe notes, read the acronym, they are not safe. So
a little bit of a misnomer there.
Yeah, little misleading name on those from my experience, but there's people out there with a lot more expertise than me. So realistically, when you find the expert who's going to help lead you down that path to that funding, you listen to their advice, right? There are different people with different methodologies in the CPA and the tax law space that are experts. Rely on the experts. Find the experts first, right? Don't go to and I'm not in any way downplaying the value of just local tax preparers, but don't go to the tax preparer at the end of the block who specializes in a 1040 with a W-2 and maybe a 1099. You want to go to the experts. And at that point, if you're going after that kind of funding, spend the money, find the expert in that industry that has that knowledge. They will lead you down that path. So I think I want to be a Delaware C-corp. Why? What are you going to do with it, right? Those are the questions they're going to ask, and they're going to have already done it. Find people with the experience. There's different types of CPAs, different types of attorneys out there.
As we wrap up here, Evan, when should I come and talk to you as a founder? Like, when do you want to hear from me? Like, is it before I start? Is it as I'm getting going? And regardless of entity size, like, when should I start to actually talk to tax professional, legal professionals? Like, should it be even before I start or as I'm getting going?
I see it as a trifecta, right? So if you are looking to found something, you want a broad view of the situation, right? You should probably talk to a CPA, probably should talk to an attorney, and probably talk to a financial planner or wealth advisor, right? They're going to give you three very distinct points of view. Your CPA is going to be like, LLCs and S-corp. Your attorney is going to be like, Delaware C-corp. Your financial planner is going to be, how are you exiting this? They're going to ask the question that's probably going to trigger some more thought and some more discussion. So I would start earlier, not later. You can always go reserve. You have a great name for a company, but you haven't figured out what to do yet. Just go get a trade name on the Colorado Secretary of State website. Just go file the trade name, hold on to that name. Then you can file the LLC. Then you can do the rest of the stuff. So if you're going to have the next great idea for an app and you got a great name, go file it. Maybe do a trademark, do a service mark, something like that. But then go talk to your experts, right?
So one last point, and I'll just be, because I hear this a lot from other founders, is that early stage founders are a little intimidated because they don't have any money. It's like almost every lawyer and accountant will just talk to you for free the first time, right? Like you don't.
Yeah, you get 15 minutes to half an hour usually free up front.
Yeah, exactly. Right.
That is tough. But again, you can always start with a trade name and build up from there. Now, most CPAs will have a conversation. Most financial planning firms will have a conversation. There are financial planning firms out there that have seen this over and over again with people exiting their businesses. Attorneys, I know a good one who'll do 20, 30 minutes for free up front just to talk about the situation and then take an arm and a leg after the first consultation. So,
right.
It's tough. And I think people come to this for those resources. You can also talk to other founders. So this is what I see a lot, right? We've got someone who's got a successful business where they've just exited. I can think of half a dozen of those guys. And now it's the next guy that bought the business, or it's a friend. And they're calling up and they're going, hey, I'm friends with, John Doe, and you guys helped him exit his business. I've got some questions, right? And a lot of times you can leverage those connections. Founders that know founders can leverage those connections and find the resources that can guide them down that path. I would use the network.
I think that's a really good point to end it on.
I think that is a shameless self-promotion for How to Founder. So
exactly.
Thank you very much for that. And also, I will say that you can get 15 minutes from an expert, or you can get a full hour if you start a podcast. So I really appreciate the time that you spent with us, Evan.
Evan, thank you so much.
Where was I sending the invoice?
Well, we don't have an entity, so exactly.
I can't hear you now.
Chris, and it'll probably get the same amount of attention.
Right.
It was awesome. A pleasure. Small business is the lifeblood of the company or the country. I think there's 30 million plus small businesses out there. Love them all. Hope you guys can spread the gospel and really make some, efficiencies in their life.
Well, we so appreciate it, Evan, because I will tell you that even though this is not as much fun as talking about how your product's going to make $1 billion. It's so critically important for founders to understand and really just start down the right path, because again, Anthony and I have about 1.5 million stories, just like Richard. We don't want to be Richards. We don't want to do that. So it's been a great conversation. So I think let's put a cap on this, Anthony, and say, so we'll finish this episode up and see you next time. But what do we have coming up next week, Anthony?
So on Tuesday next week, I will real programming note. Tuesday next week will be at 7:00, and then by popular demand, we're going to be switching to an 8:00 live broadcast. Mostly because Chris can't seem to wake up early enough to make the 7:00 easy for him. So we're going to be switching for Chris.
Right. Yep. Thank you, everybody. I need my beauty sleep. This doesn't just happen.
That is true. So on Tuesday next week, we'll be talking about the myth of work-life balance. And to wrap things up, remember to follow us on LinkedIn at linkedin.com/companies/howtofounder. Or on our How to Founder channel on YouTube. All right, guys. See you next Tuesday. Thank you very much. Thanks for following.
Thank you, Evan.
Pleasure, guys. Take care.
Bye.